Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Dick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Monday edition of Benzinga's PreMarket Prep. Spencer Israel back with Joel Elconin and Dennis Dick. On today's show, we are going to discuss the follow-through from Friday's trading in Lyft, what Friday's action tells us about the future of the stock, or at least the short-term future of the stock. We'll talk about the biggest ratings changes of the mornings. We'll talk about maybe do a breakdown of the top 10 components of the S&P futures as well. And we'll be joined today at 8:35 by our guest, Steve Sears, Chief Market Strategist at Stratify and a Barron's Weekend columnist. Joel and Dennis, I missed you both. Joel, how's it going?
Going well, Spencer. How was Mickey Mouse, Donald Duck, and the rest of them?
They're still alive, Joel. They're still there.
They're still there.
The crowds.
The crowds were not bad, actually. Not bad. And we got lucky with the weather. So it was, I don't know how much detail you want me to go into, but it was.
Where'd you go? Which parks?
We did Magic Kingdom, we did Epcot, and we did Universal Studios. So those were the three we did. And,
what's the best one?
Universal is more known for its rides, I think. It's less, characters, more rides. So,
right, it's not as much for little kids.
Exactly. So, and that had Harry Potter World. And let me tell you about Harry Potter World. It's a racket. You can buy a wand, a piece of plastic. They charge $48 for a wand, or you can get it for.
What's the wand do?
The wand doesn't do anything, or if you want to get it like quote unquote with magic, you can point it at like the shops, the windowsills in the shops, and things will move, and that's $55.
Oh, that's cool.
So you
bought it with magic, right?
I didn't buy anything. Or you can buy a robe, like a Hogwarts robe for $150. So.
What's the robe do?
It's nothing. It's a robe.
Okay, the wand with magic sounds cool though. So like you just walk around and point at things and things move?
Yeah.
Well,
you point at stuff and like stuff happens. It's like it's cool. Interactive. But
so I would never buy the wand without the magic.
It's $55. It's $55.
It's like 10 extra bucks to get it with magic?
Yeah.
Oh, and yeah, I would go. I actually want to go down there and just see that. So you walk through and you just like point at things and it moves.
Yeah,
nice.
Yeah, I mean, pretty much, but it's a racket. But it was
to buy that with the wand. Oh, you could have brought this on the show and we could have done magic to the stocks.
Yeah,
this wand.
Yeah, you're right. We could have, but
that's what I want on Amazon right now.
There's already magic going on.
Harry Potter, wand.
There's
already magic. Joel's here. Joel's magical. His bracket's probably not magical anymore. My bracket.
What bracket? What bracket? What tournament? What bracket?
What tournament? We don't even talk about this.
How about those?
I bet there's a few people in the office that got state, though. Is there a few people in the office that got state? There's probably a few brackets in that Benzinga office that are looking pretty darn good this morning.
Potentially.
Yeah, I think Matt Cole, I'm sure, has it. So congratulations to all the final four teams. Unfortunately, my team's not one of them, but that's all right. I just won't watch TV next weekend. Anyways, S&P futures are ripping this morning. Just follow through on that strong close from Friday. Yeah. We got over an area of resistance. Pre-market high 61 and a quarter. We're trading at 59 and a quarter. Really only number on the upside, and that's 28.66, and that was the high of the move that you had from a few weeks ago. So we'll be keeping an eye on that. Crude is catching a bid as well, up 67 cents at 60.81, ready to break into the $61 handle. Gold's in the red by 280 at 1295.70. Silver in the red by a nickel at 15.06. But let's start with that Lyft IPO, Dennis. And
I want to start with Friday's action. Then we'll get into Lyft.
Sure. Okay.
Because just recapping, so we said on the show, these days at the end of the quarter tend to be positive days. We were strong, and we opened strong, and we just stayed strong. We really didn't go that far, though. We had a little bit of action on the close. Some of the stocks were trying to go higher there on the close. Johnson & Johnson came up quite a bit there at the close. So there was a few but it was kind of it was definitely some strength. But what's interesting here, so you could say the window dressers, they were there at the close, pushing it at the end of the quarter, but they kind of pulled the wool over our eyes because I did not anticipate them pushing us up at the beginning of the quarter. This is a hell of a move here this morning. Do we have a catalyst here, or is this just follow through, Joel, breaking out now? Thoughts, technically speaking, on the SPY, because we're looking at it here now. We're challenging the highs that we were at just March 21st, which was 7 days ago. Do we break out? Are we on a breakout here? And am I going to win my bet with you before the end of June?
You may. You're itching it up on that. I think what you had is at the end of the week on Friday, we had a fairly tight range for the entire week. And then on Friday, we made a new high for the week. And a lot of times you get Friday, Monday follow through. Also, you're just in an area of very little resistance. When we came down hard, I think you said it was March 1st that we made that high. We came down off that level. It was straight down. So there wasn't any really resistance to talk about. So when you take out the highs from last week, it's actually migrating up to this 2866 area. That's the target. When there's no resistance, there's no resistance. That's pretty much what happened. You got the strong follow through, and I see China's up a little bit. I see all the top components up a little bit. Barron's they were bullish some stocks. They weren't bullish across the board. You got some movers like Merck. Everything's up on the follow through. So we'll see. We'll get up that test at 2866.
Did Barron say something about Merck?
No, but there is news on Merck. We got a lot of news on Merck.
Well, we're going to get to that in a second there too. And I agree. There was some data overnight here. Chinese stocks are very strong this morning.
Yeah.
If you're looking at the EEM or the FXI, both up 1.29, 1.47%. If you look up to some of the big names, Alibaba's trading up 1.83% here this morning. Looks like it's a good day, obviously, and for Chinese stocks. It's a good day for all stocks here this morning, because I'm looking at my screen and you're challenged to really find the red here this morning. It's going to be, looks like a rally across the board to a certain extent. The TLT is down. Sometimes some of your defensive issues, think about your REITs, think about your utility stocks. Those could be weaker. XLU is basically trading flat. But with the TLT down as much as it is, I would think bank stocks are probably going to have a pretty good day. They're having a pretty good pre-market. Bank America up 1.1%. JP Morgan trading up 1%. I'm long JP Morgan as a day trade. Full disclosure, Morgan Stanley, Goldman all trading higher. So you're seeing a lot of stocks trade higher. One stock that is not trading higher, though, is what you were alluded to a couple minutes ago, Lyft. Lyft not getting a lift here with the rest of the market this morning and drifting down. First of all, thoughts on Friday's trading action with LYFT, and then thoughts this morning as we see a broad-based rally here and Lyft straight down.
First, why don't you put that order that you had? You showed the order book on your Twitter feed on Friday. Someone had that huge order at $1, I believe.
Yeah.
There
was a couple 100,000 to sell at $1, and it was probably one or two institutions. What they're doing, so this was the order book before the stock opened. And when you see a $1, somebody selling at $1, that's just saying, I want the opening print. So I'm just going to put this at $1. They're going to give me whatever the opening print is. They obviously don't get printed at $1. When you put your order at $1, you get the price improvement of what the opening print is. But all that order is saying, get me out on the open no matter what the price is, because we know it's not opening at $1. So good call by that person who was selling at $1, 200,000 shares. Because the stock opened at 87, hung there for a couple minutes, and then straight down. So it was a good call. Whoever was selling that $1 order that looked kind of silly in the book when I saw on my Twitter feed, turned out to be pretty smart.
Yeah, it looks like that. They opened it just a little bit too high, trading down $2.79. I just heard this news. I didn't read fully into the story, but I think there was an unfortunate incident with like an Uber or Lyft driver in South Carolina. It wasn't actually an Uber or Lyft driver. A young lady had called one of the ride-sharing services and actually got picked up by somebody else, and was not a good result. So I don't know.
I did hear something about that too. That's
it's
scary.
Unfortunate.
That's a scary thing. That's always a scary thing that, I've thought about too when you're getting an Uber or a Lyft. Some of these people sign up fairly quickly. It's not like you're going through, some long process here to become a driver. So you just wonder if all the drivers are safe. I guess this one wasn't actually the Lyft driver, though. It was somebody kind of disguising themselves as that car that was supposed to be picking them up to a certain extent. So that's scary in itself. But I think, the trading action this morning is just a simple reason. First of all, the analysts that came out this morning, whoever was coming out, nobody gave a buy rating really. So Spencer, just verify that if you want. But I'm looking like Lyft got neutral from Guggenheim, equal weight from Consumer Edge Research. I mean, and they see growth slowing. They said Consumer Edge Research, which probably nobody wants to hear on the second day of trading on a new IPO. I got to think you've come this far from 87 down to 75 and a quarter. I got to think you're going to test the IPO price of 72. Let's see if the underwriters will step in there. Often on the first day they will. I don't know if they're going to step in there on day two, but you got to think if it does get down to 72, I would think it maybe bounces there the first time, but who knows? See what the underwriters do there at 72, but that's going to be the big level for the stock coming in. So always when stocks making new lows, you say, well, you have nothing in there. It's not true. You have a lot of people in there who got longs at 72, and the underwriters, that's where it's underwritten from. So 72 is going to be a big number for the stock.
Yeah, JV spec mentions, the tractor beam, just being tracked, sucked in towards that level. So we'll see.
If there's some defense going on there,
yes.
And that's one of my terminologies that I created was the tractor beam. And when you find something like a big buyer or a big seller, what tends to happen, you could call it the magnet trade too. I kind of use a tractor beam. The reason I labeled it tractor beam is because I'm a Star Wars fan. We know that if you've listened to the show for a while. So I like the tractor beam. We call it the magnet trade. We call it that sometimes too. You get a big size and then somebody big in the book, the stock can get pulled towards where that big buyer or seller is. And that's the simple reason is that you have shorter term traders that have identified a big buyer or seller in the book, and they will step ahead of it trying to sell short if it's an offer or buy it ahead of if it's a bid. And as they do that more, these are short-term scalpers. They flip out the stock and go the other way. And what that tends to do is put book pressure the opposite direction and actually tends to push it towards where the big buyer or the big seller is. I call it the tractor beam, but you can call it a magnet trade. So basically big institutional buyers or sellers can sometimes actually pull the price in towards that. Just the natural market mechanics can pull the price in to where that big buyer or big seller is.
Right, and there we have it at the $72 level.
You would think. We don't know anything.
We don't know if they're going to support it. But
they're going to support it today. I would think they would, at least. Maybe not, though. On day one, they almost always, like on Facebook, we have precedents here. On Facebook, when the underwritten price was 38, that day one, they would not let it fall below 38. On day two, they let her go. So you're day two here now. Are they going to defend the 72 level? If we get there, and we've come a long ways, that's why I think we probably may test it today. We're still $3.50 away from there. If we do get there, do they defend the 72? That's the question. If it starts cutting through and it looks like there's nobody defending it there, well, then all bets are off. But I don't know. It's going to be interesting. If it was day one, I would say they're going to defend that 72 level, but it's day two. So I'm not sure they're going to defend it or not.
All right. I actually just, if you all Google Facebook tractor beam video, you will see a video that Dennis did on YouTube.
Where you did it too?
Yeah, it's I don't know. I think you might have been solo on this one. I can't remember, but 27,000 views, and it just is the price action when it got near that bid, and it was supported. Yeah. So the high frequency traders came in and were buying at 01, selling at 03, buying at 01, selling at 04. And you had a really tight market at that point. But the farther it got away from 38, boom, then
it breaks the tractor beam and escapes.
Yeah, exactly.
Old Ben Kenobi got off and turned it off the tractor beam. The Millennium Falcon got away.
Yeah, that's
now if you're not a Star Wars fan, you have no idea what I was talking about there.
Could you? I don't think there's Lyft is shortable yet. If it is, it's probably a really high rate.
2-day settlement, right? So.
Yeah.
Usually it's going to be very difficult. After 3 days, you should be good to go, though. You should be able to find some stock anyways. But yeah, I would think it's not going to be able to be located anywhere today.
Since we're talking
I just
about
locate out there just to find out, see what's happening. No good. So I just tried mine. Yeah, no good. I think you got to wait for day 3, the 2-day settlement.
Let's do a live example here when we're talking about big orders in the book here. You have Johnson & Johnson trading up 31 cents and is trading over 140. Now, last time it got back up to 140, Dennis, I think you identified some big orders in the book here. Is
Funny you say that. I've already played it off of it. So I actually shorted Johnson & Johnson overnight, hedged it with SPY, so it's going to be a winning trade. But I knew I had the seller to lean on at 140. So 210,000 shares offered at 140 right now. Unless there's news coming, I would think there's almost zero chance that J&J opens over 140. So now once the stock opens for trading, we know Johnson & Johnson can sometimes trade 4 or 5 million shares. So, at least a couple million shares. So 200,000 isn't that much. But pre-market trading, if you look at J&J, it's traded 3,300. And I'm actually a good chunk of those 3,300. So, because I've covered already this morning under 140, or I was covering right around the 140 area. But I think there's very little chance it opens over 140.
Okay. Yeah, I just figured, we had showed in the past about the order with the Facebook. I just thought we would show it with a real live example here with the Johnson & Johnson.
Yeah, like it, and the thing is, it's not really trading actively. The nice thing about the Facebook is so active, and you get these big defensives. This is where you can really notice price action change. But whenever you get to a level that's got a big buyer or a seller, the stock, you'll usually stall there, unless it's maybe it's going to blow through it quickly. It doesn't have to, I guess. But sometimes the stock will stall out there as it takes a lot of pressure. So just do the math. $140, 200,000 shares. How much money is that, Spencer? Grab your trusty Benzinga calculator there and add that up. It takes a huge buyer to obviously take that out. So if we just go rough, it's 220,000 there now. So 220,000 shares times $140. It's going to take $31 million worth of buying pressure to take out the 140 seller. And people will say, oh, how do you know that's real? Well, it was there Friday, and you tend to see the orders being real when they're at big whole numbers like that. Because some institution, they're saying, look, ever gets up there again, 200,000 shares, I'm going to dump it. So these orders tend to be, 90% of the time, I would say these things are real when you see them at the big whole numbers like that in the pre-market. During the regular session, it's completely different. During the regular session, not necessarily fake, but there's envelope orders out there. There's a lot going on. There's market making orders, a lot happening. But when you see an order in the book, in the pre-market of 200,000 shares at the point, it's usually real. So it's going to take that $31 million worth of buying pressure Johnson & Johnson to take out 140. That's a lot of money. So it's highly unlikely it's going to get that in the pre-market where there's enough buyers that it's actually going to open over that. So I would say it's a pretty safe bet to say Johnson & Johnson probably not opening over 140, despite the market being up significantly today.
And it just ticked out 139.90 there, but
yeah, it's just odd lots there. So, and there's people selling, and I'm with them. I mean, above 140, I think is a safe pre-market short because you can cover at the open and probably make money. Like there's some odd lots went up at 140.32, 140.50. Those people aren't paying attention to the book. If you're buying this above 140, you're probably going to, not necessarily lose money if you hold it long enough, but you probably can get it cheaper because I would say it probably. In all likelihood, it's probably going to open at 140, or maybe we get one of these situations where this is a stock that is a little more defensive and actually goes down today. But I don't know if that's necessarily the case. I'm just saying it's going to have a lot of difficulty opening over 140, and that's an edge. That's an edge by you taking that book knowledge, the information from the book, which is publicly available if you subscribe to it, and trading on it. So I mean, that's what it's all about, is finding that edge. And that's an edge that's right there for you if you subscribe, $60 a month.
And what was the stock that last week you gave this example in, and it worked out as well? I can't remember.
Well, GIS. I traded GIS.
Yeah, that was GIS. Or maybe, that was.
So then those are nice ones. When you get a big level on in earnings and you're like, I don't think it can take that out. And I was looking at it. I think there was a big sell like 51. It was trading like 51.50 or 51.60. And I got short up there. And I made a point on it. So, and I mean, I've just felt comfortable that I don't think there's enough buying pressure here in the pre-market that it can take out that 51 sell on the open. I think it opened well below it too. I think it opened like 50.60 or something, like well below where the seller was, because there simply wasn't enough buying pressure to take that on the open. Those are nice setups when you get something, trading up and everybody's the hype and the bots are buying. They're not looking at the book. They're not reading the book pressure. And that makes a big difference. So I'm all about order flow. Like for the most part, most of my trades, my intraday trades, are looking at order flow and understanding, and that's the trending too. I mean, some of that you can see in a chart, on an intraday chart, something's buying every pullback. Well, that could just be an institutional algorithm that's just using, and just buying in, obviously, on a continuous basis. So it just tends to trade up as the algorithm continues to feed buy orders into the market. So sometimes it shows up in the chart, sometimes it doesn't. But I mean, from an order flow perspective, when big institutions are there, they move price. And when you can identify that institution, whether it be through, looking at, a chart or looking at the book, there's an advantage for you there, because that is going to move price. Institutions move price. High frequency traders don't really move price. It's institutional orders that move price. High frequency traders are sitting there trading in between the institutions. They're trading, they're playing a market making role. They're leaning on everything for protection. That's just the way the market makers are. That's the way it's always been. You've always leaned for protection on the big money. That's the way the markets work. I mean, even in the pit, Joel, think about the pit days to you. You can talk about this. The locals in the pit would lean on the paper.
Oh, yeah. Yeah. If there was a big offer, 1,000 at even, I mean, you would have the world at 95. That's when they traded in nickels, because they know
if in a worst case scenario, they're going to be fast enough to lift that paper. So you're risking a nickel for a free look at the downside.
Right.
So, I mean, that's what, and when I started in 1999, Brad, it's the same thing. We're identifying, big institutional orders and leaning on it. I mean, that's really what it's always been about. And it still is that. It's just done on a microsecond level for the most part during intraday trading, because high frequency traders have sped it all up. And you can't beat them. I mean, when they decide to lift the offer, it's done so quickly that the human being trader is probably going to miss it. It's not the same at the open, though. I mean, the open isn't that 140 liquidity, that 140, 200,000 seller isn't active yet. So you cannot lift that order right now because it's not active until 9:30. Now, maybe at 9:30, everybody lifts that order and it goes through. We don't know. But that's why you can safely say it's probably not opening over 140.
And just a little trick that they used to use on the floor, if there is, a big size, and let's say 59 even, and, they were, 1,000 at even, and then all the locals would undercut at 95. If there was a big trader in the pit that was long, right, and they wanted to get that size, taken out, he'd go, he'd look at the broker, and then he'd go buy them in 95. And then, he would lift the offers of the locals, but everyone thought that he was going to be lifting the offer up top. Yeah, it jumped up. That's just but those tricks don't happen anymore, because there's really no.
They might happen. They just happen on the microsecond level, so we don't see them.
Yeah, exactly.
They sped up. High frequency trading, all it did was speed up pit trading, really. Really, when you think about it. I mean, that's what high frequency trading is. It's like you can say, oh, there's a lot more, and there was always, the one thing about it, there was always stuff going on that was probably dirty, and some of the high frequency tactics, maybe some dirtier traders out there. The one thing about the pit, though, it would police itself. So if you had a trader throwing out fake orders or doing stuff like that, nobody's going to trade with them, or they're going to, literally go punch them in the face. I mean, it's a completely different story. So that's the one thing. It's all anonymous now, so it's a little bit different where it can't police itself as well. But for the most part, the high frequency trades is pit trading sped up.
Yeah, I have to agree with you on that. All right, S&P's still up 20.25 points, 28.58. We got some positive news from Merck today, Spencer.
A few headlines, actually, so I'll just go through all of them here. Merck and AstraZeneca announced a breakthrough therapy designation for neurofibromatosis type 1. Merck's Keytruda got approval in China, and Merck announced a partnership with Sage Therapeutics and Alkermes and Takeda to develop a schizophrenia drug. So the Keytruda approval in China is, I think, the big headline here, but three headlines on Merck this morning.
Bristol Myers is a competing drug, I believe, with Merck on Keytruda, do they not?
Yeah.
I'm going from my memory here. I think there is.
It begins with an O, I think.
Yeah, I think Bristol Myers is a competing drug here. So just careful on Bristol Myers here today. I know there's news with Celgene and all that, but think about that too. If Keytruda is getting some approval over in another country, that could have pressure on Bristol Myers because they do have a competing drug. But there's so many other variables happening with Bristol Myers with all the Celgene stuff from the last couple of days too that can just be wild. Merck, first thing we just talked about book pressure. Let's look at the book.
Yeah, I was just going to say that. Yep.
Yeah, it's thick. So 83.50, 23,000 shares, and this is a New York book. It could probably take. It's trade 7,400. It's going to trade some more before that. 84 though, 40,000 shares. So people buying 84.35. I don't know. If we trade a lot more, we maybe could open over 84, but you could be challenged. It's not huge. It can take that out. I wouldn't be as comfortable saying I don't think it's opening over 84 as I am with the Johnson opening over 140, which I don't think is going to happen. I don't think Merck is going to open over 84, but I don't know if I'm confident enough to short it because it could pick up some volume and then get you. But then you look 84.45, it's got some size. 85 is some serious size. So I'd gather to say I think there's no chance open over 85, and I doubt it opens over 84. In my opinion, I doubt it.
Yeah.
And full disclosure, Merck is one of the largest positions in my long-term investment portfolio. It used to be by far the biggest, but I actually have lightened it up. I lightened up a little bit more in December even when I got nervous about the overall market. It's a stock that I bought back in the 30s when everybody hated it. You know how I'm a contrarian investor. And back in 2012, 2011, they knocked this thing down to the 20s. It was trading with a dividend of 6.5% back then. And I just threw it in the long-term portfolio and made it my biggest position. That and Eli Lilly. Those were my two biggest positions back then. I'm completely out of the Lilly because it went from $29 or $30 where I bought it up to 90, and I thought that was good enough. Obviously 130 now, so I wish I would have held some. Merck, I have held some, but I've probably sold 2/3 of the position. It's still big. So just because it keeps going up. So anyways, long term, I still like Merck, but short term here, I don't know if it's open over 84.
Yeah, it's trading at the highs of the pre-market session. 84.41 is your current price. I mean, just think about how much stock has to trade to move this one during the actual regular session. So far, your pre-market high is 84.50, but we'll see if there's enough buyers off the open on this one to take out the sellers here in the book. And I think that Rocket 1530 has helped me. It's OPDIVO, Opdivo. Is the I knew it began with. Yep, I knew.
It used to be because, and I don't know how much it's still going to affect it, but I used to trade whenever I saw Keytruda data and it was positive, I'd actually short Bristol Myers on it. It was a trade on that. And I'd done it a few times and made money. I don't know if that's going to be the case today, though, again, because we got a lot of Celgene stuff going on, so it's not as clean. But other things being equal, when Merck has positive Keytruda data, it's usually bad for Bristol Myers.
Okay. Spencer.
Silence comes over the crowd. They don't like that.
That was a good that was a good way to wrap that up. Do we want to we have about 7 minutes before our guest. Do you want to do a breakdown in the S&P top 10? We haven't done that in a while. We can talk about that. We can talk about the airliners today having some data issues. We can talk about Tata Motors. Where would you like to go?
Why don't we cover some more of the news stocks here and maybe get to that after the break because we're getting a lot of questions here. Sure. Elizabeth S. is asking
the chat stocks,
the chat stocks here is Elizabeth is asking about AstraZeneca, AZN.
News here too,
Yep, and they got an upgrade, right?
Cowen.
Yep, an upgrade to outperform from Cowen, and they're raising their price target to $48.
Didn't you say this was with the Merck though? This is drug approval.
They've partnered. Well, not Keytruda. They've partnered with Merck for a for
separate news.
Yeah, separate news for neurofibromatosis type 1. So they partnered with them for that.
Tough chart here.
AstraZeneca getting a big lift. One thing to consider, it's an ADR. This price discovery has already happened. This is obviously trading over in Europe here right now. So it's not like, where do you think this is going today? It's already where it's going. It's up 2.4%. They priced this in Europe. It's already traded 90,000. Here's traded a ton more though over in Europe. So it's easy to say where the ADRs are going because they're already priced a 2-cent market here, right now, 1-cent market. Your high frequency traders, you can actually thank for that because they just do the arbitrage back and forth. But I mean, you look at this and it's traded where it wants to go. So I don't know if there's much more to say.
All right. We must have some selling balances there, Dennis, because the 830 ticked, and we also got.
Do we have some data?
Yep. February retail sales is coming out here. and we will get the reaction on that. Just had a little blip down of about 3 handles. So it looks like we are waiting here or in anticipation of the retail sales. But we did get a little dip in that. What's corresponding with imbalances? Anything there, Dennis?
There's mostly buys, so it wasn't imbalances that knocked us.
Okay.
It was the data that just broke.
Yeah, core retail sales were down month over month for February, down 0.4% versus an up 0.4% estimate for the core retail sales for February. Down, that was month over month. So down 0.4 versus up 0.4. I don't know if that's enough to do it, but that was the data.
Okay, just a quick
Bank
dip.
America 187,000 to buy. That's significant. Banks are stronger today again because the TLT is weak. AT&T is interesting though. Is there something on AT&T? 279,000 to buy here this morning. Stock is trading up 0.8%, which is a decent move for AT&T. It's actually up more than the market, which is weird because AT&T is actually more correlated to the TLT than is the SPY. I'm not sure if there was a headline there or not that I missed.
Just to cover a Barron's.
Oh, is that it?
Yeah.
There's always something. I can speculate. I should gotta get what was on the cover, Barron's.
Basically Comcast versus AT&T. Which one's a better value?
Verizon.
They like them both because they're both trading higher.
Not Comcast. I'm sorry. I don't know why. Verizon
versus AT&T.
Yeah,
they're both up too.
what do you think? Which one do you think they favored?
Verizon.
Nope.
They favored AT&T. They like the 6.45% dividend.
They just think that, and it's just comprehensive. You know, they think the overall content strategy is going to work out for them, as opposed to Verizon building out, the network and going for, I'm sure AT&T is working on their network too, but they just think that all the things that they're doing, all the debt that they're taking on, the acquisition of Warner is going to add to the bottom line with content. It also has a better dividend. But you know what I think the most interesting part of the article was, and I don't know if it's just company policy, but AT&T basically availed all their executives and management to talk to Barron's about this piece, where Verizon refused to comment. So I don't know if they, if that's just their policy or whatever, but it was definitely slanted towards AT&T, and you have that trading up 25 cents this morning at 31.61, and then also Verizon's in the green too here because of the market. But I usually don't read those super long articles, but this one was pretty good, and they just think,
are you going out buying AT&T on it?
Not up 26 cents. I'm sure it will fade a little bit, but 6.4% dividend. Whether or not it's gonna, have any capital appreciation. Also, they said in the article and that the dividend's safe here. So, unless you think this is dropping 6-7%, then yeah, it's a good buy. Where are you going to get 6-7%? On your money? So
I had AT&T in my long-term portfolio for a decade. I sold it last year, and the reason I did that is I'm actually of the opposite opinion of Barron's. I'm not 100% convinced that the dividend is safe, and they had some bad buys. So DirecTV, we know they paid too much for. They're cutting the cable. I just see margins getting squeezed here in the future too, though. I look at long-term. When I'm in long-term, you're trying to think outside the box. You're trying to think like long-term. And you could say, mobile phones, you think about all the money that they make from all that. Yes, but that's going to get squeezed in the future too. Things get more efficient. And I just don't see, I don't see myself paying $200 a month for my 2 cell phones 5 years from now. I bet you there's going to be more margin pressure there. And if that continues, the market will pre-price all of that too. I think long-term, I think AT&T is going to have more margin pressure than you think. And that could actually put pressure on their cash flows, which could eventually put pressure on the dividend. Do I think they're cutting the dividend tomorrow? No. Do I see it potentially in the next 2 to 3 years? Yes. That's why I've sold the stock.
All right. That's a good analysis.
So I'm of the opposite opinion of Barron's. I don't like AT&T here.
Okay. Are you shorting AT&T on 28 cents?
No, probably not. What I day trade it? Yeah, I trade it all the time.
Only Dennis.
I don't long term. I don't like it.
Only Dennis.
I think there's better places, safer places for your money.
only Dennis could hear the AT&T exec say the dividend is safe and interpret that to mean the dividend is not safe. But
no,
hey,
I said it's safe.
To each
I
their
said
own.
it's safe right now. I said in 2 to 3 years, I'm not sure I have the same story. And I think the market predicts that stuff a lot. Like we saw with GE, GE started going down a lot earlier than they cut the dividend. For a year, GE went down before they cut the dividend. So do they cut the dividend 2 to 3 years from now? I don't know. I don't think it's as safe in 2 to 3 years as it is right now. It's not getting cut tomorrow. It's probably not getting cut this year. 2021, 2022, I don't know. If the margins continue to get squeezed, people continue to cut the cable, because you got to break it down and see, like a Comcast or something, I'd be scared of. But obviously, internet provider, is still going to be there. But that's all margin pressure on that too. Okay. And we know people are cutting the cord on the cable, so those operations are going to get squeezed for sure. So there's a lot of issues there. There's a lot of debt there too. Yeah. And that's the scary thing. So I don't think it's just a slam dunk. I'm getting 6.45% of what can happen. Things can happen with the stock. That's why I'm out. I had it for a decade in my portfolio. So, I put some thought into it to actually get rid of that stock. And I finally sold it here last year. And, and it's at a 6.45% dividend. So I'm more nervous than Barron's is, I'll tell you that.
All right, let's take a quick break and grab today's guest, Steve Sears, Chief Market Strategist at Stratify and a Barron's columnist. We'll be back in a moment here with Steve. And welcome back, everyone. We are now joined by Steve Sears. As I mentioned, he is the Chief Market Strategist at Stratify and a weekend columnist at Barron. Steve, how's it going this morning?
Fantastic. How are you doing?
We're doing well here. Not quite as well as the market here, trading up strongly this morning. But just real briefly, we've had you on a few other times. But just tell us a little bit about Stratify Technologies, being the chief investment officer there. I think it's been a little over a year now. Just tell us a little bit about what you're doing over there and what services they offer.
Well, we're trying to democratize risk management, taking what happens on institutional trading desks, simplifying it with a technology so that individual investors and their advisors can make better decisions and be better investors.
Okay. Interesting article in Barron's this weekend. So glad you're back there ready for the publication. Volatility makes a comeback, and you put an interesting quote in there that you hear a lot about, but you never hear like the full explanation of it. And when the VIX is high, it's time to buy. When it's low, it's time to go. A common saying that you heard. Could you just did a good interpretation of it in Barron's? I was wondering if you could just break it down for us here on Benzinga's PreMarket Prep.
Absolutely. What it simply means is that when VIX is high, fear is high. And it's a great time to buy stocks, usually. And when VIX is low, it's time to go, which means that it's a good time to use options as proxies for stocks, or it's a good time to hedge the risk of owning stocks. Because when VIX is low, it typically means, as it is now around 13, it typically means that stock prices are high. So this gets used as a sort of fear and greed indicator. Now, if you go back to, VIX is high during the crisis was around 90. And at that time, everybody thought GE was going to go out of business, and GE still could, and a number of other major companies. But if you just simply focus on this one indicator out of the many that everybody watches, it marked one of the greatest times to buy stocks. We fast forward today, and the VIX is low and stocks are high. In fact, I just saw that the first quarter was the best quarter since 2009 for the S&P 500. And it raises some interesting questions about how risk is metabolized.
Okay, all right. That's a great breakdown of it. Now, I guess the only tricky part of that is, like, you know, when the VIX goes into these extended periods of of spiking and stuff, it's usually not a 1 or 2 day event. It usually extends a little bit. So, do you have anything to the actual timing of this when when you're trying to gauge the fear index and then their positions? Is there like a time horizon that you like to use?
This is the art of trading, quite frankly. I think what you do is you use when the VIX is high, it's time to buy, and when the VIX is low, it's time to go, as sort of the dial on your trading dashboard. And then you can go look at individual stock sectors, ETFs, the VIX futures curve, skew, the difference between the implied volatility of out of the money, puts and calls, and then you make a decision. Sometimes the way these things work, you're going to make intraday decisions. You'll be sitting there and suddenly something will happen that's unexpected. You'll see a huge surge. You're going to buy it or you're going to sell it. That is increasingly how a lot of the algorithms are treating these vol spikes. But again, this gets down to the art of trading and how you bend it into your own particular discipline.
And then also, just talk about, hedging and, the timing of hedging. And you mentioned, the VIX is following as an indicator, maybe not so much trading. I mean, overall, in this market, hedging and portfolio insurance really, really hasn't, because we're in, just a great bull market here. When do you gauge, or if your clients or customers are talking about, hedging, is it just something that you have to be very disciplined about and just be consistent in doing it? So, because if you're like, okay, I'm done, I've lost enough money on hedging, I'm not doing it. How do you figure it out systematically?
Well, it's funny. I was just at the CBOE's Risk Management Conference in California, and this was a major topic. And so gathered in the room were a few hundred of the top derivatives traders and hedge fund portfolio managers. And the general consensus was, as it has been now for about a year, is that you look at putting on zero cost collars, or you look at putting on spreads. You look at doing things that limit hedging expense, because hedging expense has been wasted in many instances. Now, why would these guys be doing, these supposedly very smart investors, if they've been losing money on it? Well, as a number of them will tell you, the reason they do it is because if they don't and something happens, their investors, their clients are going to look at them and basically say, hey, dummy, how could you have been exposed to full risk? Now, this is going to seem strange to a lot of people who are just, as they say, long and strong, or riding the trend. But most people who manage money professionally, as you know, tend to view the world as a glass of water that's half cracked and growing a little bit of mold. They're mostly concerned about what they don't know. And so they'll spend it. Now, is this why some of the hedge funds and others are trailing benchmarks so severely? Yeah, could be.
And let's just talk about the overall market, the Fed tizzy, with rates and the stance that the Fed took. knocked the market down, knocked the bank stocks down, but they seem to be coming back. I mean, just overall, market action, characterize it, and, what you're looking for, in the next, let's say 3 to 6 months.
It's funny. I have this suspicion that we're bumping up against the sum total of human knowledge about the stock market. I saw something recently, over the weekend about that the explanation for why stocks were going up so much was obviously, the fact that rates are not going to go up and might even go down. But somebody says, well, it's fear of missing out, or there is no alternative. So what I continue to see as a very concerning sign, and this can go either way, is that John and Jane, investor from Main Street, are all bulled up and they're buying stocks, but the institutions are not. And for a very long time, I viewed the institutional community's hesitance or doubting of the market to be the greatest contrarian indicator. Here are the smartest, most informed, most experienced people in the markets, and they're the most negative. And I think that was just sort of proving the maxim is that you actually can't be too smart for your own good. But now we're getting to a point in which this market seems to be largely dependent on low rates. We know that employment is tight. We know the wages are rising and all of these other factors. So I think the next 3 to 6 months will be very, very critical. And I'm waiting to see if any of the institutional money comes in from the sidelines, or if we see a slowdown or an increase, frankly, in margin debt. They say the trend is your friend, but it's the things that we're not talking about that usually come back to bite us. At RNC, somebody made this point that I thought was kind of interesting over lunch. We were talking about the different nations that have dealt with basically low cost rates. And they said, do you remember when Japan lowered the rates in the 80s? And I said, not really, because I was just a kid. And they said, well, where are Japan's rates today? And I said, okay, good point, because they're still around zero. And there's a lot of concern about what happens as America ages, just like Japan has aged, and we've become an older, less productive nation. So, I mean, in essence, bullish, yeah, always bullish on certain things and always bearish on others. And whether or not this equilibrium keeps things going higher or not, I think we'll know much more 6 months from now.
All right, Steve, we'll have to get you on either July or October to see if that bore fruit. Steve Stratify. Steve Sears from Stratify has been on with us today. He's also weekend columnist at Barron. Steve, thanks so much for the time, and have a good one.
Thanks, guys. Take care.
All right. 8:48 here, Joel. Any movement in the?
Yeah, we're still up at the highs of the session here. Merck has come down now. Merck is now up only 86 cents here at 84.03. AT&T is just still hanging out up 30 cents. So that little dip that we had off the retail sales number, spoos are right back up. That pre-market high is 61.25. And the high for the move, too. I mean, there's a whole interesting area up here. You had the high close of the rebound at 28.6250. You had your March 22nd high at 64.75. And then you had the high of the move, I believe, at 28.66. And that was on March 21st. So up ahead, there's your resistance. Pre-market high is just short of that. We got some news on a Battle Creek, Michigan company here. Food stock. We haven't talked food stocks since the General Mills earnings. What do you got for me on Kellogg?
Yeah, they're selling some assets here. Selling their Keebler, Famous Amos, and fruit snacks business to the owners of Nutella for between $1 to $1.5 billion.
Trading range in this one, really from since the 22nd, from 56.30 up to the upper 57s. Trading above this at the pre-market, trading at 58, up 62 cents. I mean, I don't know. It's been sleepy. This is a breakout. We're gapping up. I think I'd be more inclined to wait to see if this kind of back and fills a little bit to the 56, fill the gap at 57.49. If not, a clean breakout here. But boy, long consolidation, long decline here, Dennis.
I don't know. He's selling off assets. It sounds
not a good thing.
No, I don't think so. And they always want to rally them on these things. But, I mean, you're selling off stuff because obviously it's not producing as much as you want it to produce, or you're looking at raising cash. So, I mean, there's a 3.87% dividend still in Kellogg. It has performed quite well compared to some of the other food stocks like Kraft Heinz. Campbell's has come back. Really, Kraft Heinz has really been the only real dog of the food stocks. But Kellogg's, GIS, they've all come back a long ways. I mean, I don't know. Is it time to come in and buy these things now? I mean, there's been a pretty good move in a lot of these stocks, and they're defensive. I mean, I just don't see that huge of upside here. It's not like, oh, Kellogg's selling Keebler, I better buy this at 58 this morning, but I think this is going to push it to 60 or 62. I don't see that happening. I think the more back and fill, I think, yeah, maybe it goes up 50 cents or 60 cents on this, but could come back into. I'm just not that excited to own this stock unless you get into like a full on, like the market starts to sell off. We start to get a little bit of bear, fear going out there again. Then these stocks can catch a bid. But right now, I just don't sense the fear.
All right. Earlier in the chat, someone asked about, analyst ratings and which firms, are some firms more influential than others? And definitely there's upper tier firms. Also, there's firms that are, more, a little bit better in one category or whatnot. But Dennis, just I know that you have inner calculations here for, Goldman Sachs or Morgan Stanley or Bank of America here. Just, give us a couple of the top tier, middle tier, and then.
We covered this a few weeks ago, but I can go over it again. I mean, basically, you've got the big, your big banks, your big broker dealers who are very influential. When you see Goldman, Bank of America, which is obviously Merrill now, when you go into, Citigroup, they move stocks, like majorly move stocks. So those are ones that are going to be the most influential. Goldman, Morgan, Bank of America, Citi, JP Morgan. Think about your big banks and your big, those obviously have big say. Then you go into your mid tiers. You got like your regional banks that can have some influence there, key. And then you can get into, and there's still a few, there's a whole pile in there as well. And then you get into like the little boutiques, and some of those can move stocks too, depending on the coverage. But, other things being equal, Goldman is going to have more influence than Macquarie. So because they're widely followed, bigger institutional base, bigger client base. So those notes are getting to more people with bigger money. That's why you see, when a Goldman says something, everybody's taking note, because it's big money that is reading that note. Where are they going to read these smaller companies? Sometimes, but for the most part, they're not going to be as influential as some of the bigger guns. Although if it's an interesting note, and sometimes there's certain analysts that cover sectors that are well known. Like we know Inch is going to be the most influential, despite not being with one of the majors. He's going to be the most influential on GE because he's been right the whole time. So you've got to understand those relationships there too, that certain analysts in certain sector are better. We know, we like obviously in the solar sector, we like Gordon Johnson. We think he knows it very well. I think the market thinks he knows it very well too, because when he says something solar, those stocks will move. So, I mean, it's certain analysts, certain sectors, but other things being equal, think of your Goldmans and Morgans being the most influentials, and some of the smaller boutiques that Macquarie and those ones, they're going to be a little less influential.
All right, nice.
Still influential though. An upgrade's an upgrade. Stock gets upgraded, it usually moves up.
All right. So I did notice some analyst moves here this morning. And Spencer, we got 5 or 6 upgrades. I see 3 or 4 downgrades. Any of them catching your attention here?
Yeah, a few of them are actually. Citigroup upgrading Bed Bath & Beyond to neutral. They're also upgrading Anadarko to buy. We have a Deutsche Bank upgrade of WPP to buy. It's actually quite a few. Now that I'm going through the list here, Berenberg with the pair trade this morning, upgrading UPS to buy and downgrading FedEx to hold. We also have, going through, Raymond James upgrading Jabil Circuit to strong buy. Goldman Sachs upgrading NextEra Energy to buy. Nomura upgrading F5 Networks to buy. We talked about the Cowen upgrade of AstraZeneca. And those are the major ones. Piper Jaffray upgrading Redfin to overweight. Those are the major upgrades this morning. As far as downgrades, I mentioned the downgrade of FedEx from Berenberg. Also, we have a pair of Celgene downgrades, UBS and Atlantic Equities, both to neutral. That's pretty much it as far as downgrades are concerned. Wells Fargo downgraded at Keefe to neutral.
And what a wild day in Wells Fargo on Friday. After hours on Thursday, they really jacked it up because of the change in the C-suite. That didn't hold, ended up being negative on the day here. Just a big movement for Wells Fargo. Down to a decent support level, trading up 9 cents. We dipped around in this area last week in the lower 48. She hit 47.80 on Friday here, Dennis. Seeing anything in this one of any interest? A big volume day on Wells Fargo.
Interesting. We talked about it on Friday, and it was trading up at 51 in the pre-market. Was it not, Joel, on Friday?
Yeah.
And we were like, no.
Thursday. Yep. Thursday
or whatever it was. Was it Thursday? I thought it was Friday because that's the big calendar. The big candles from Friday. Their news was up Thursday night. Wasn't it Friday morning we were talking about?
Yeah.
Open right at the high and 10.
Yep.
Yeah. So and it was trading up like 51 in the pre-market, I believe. It didn't even open over 50. It opened 49.80 and went straight down. So I didn't anticipate it falling like that, but I was like, for it to be trading up as much as it was on that, at one point in time, I believe it was up almost $2 on that news. I was like, this is a little bit overdone. Now, I wish I would have shorted it because obviously it didn't even open over 50, opened 49.80 and tanked. So now that keeps pressure on it. I mean, this morning now you have a downgrade. Stock is not participating with the other banks here this morning because it's all of a sudden a little bit out of favor from that candle on Friday. What that creates, just from the market mechanics, is overhead supply for that day. Like you can look at those day charts. People who are buying it saying this is going to turn this, or we got some management shifts. This is going to turn around. We're immediately underwater from the pre-market. They bought at the open. They were immediately underwater, and it went straight down from there. All those people will be looking to try to get the hell out if it gets up back to the 49s. So you have an overhead supply issue now here, at least in the short term, with Wells Fargo. Until it can get back over 50 and get all those people out of pain, it's going to be a little bit harder for this one to go up other than relative to the other bank stocks. So other banks having a good day this morning. Wells Fargo, even if it didn't have the downgrade, was going to have a struggle, though, to get back to 50.
Okay. All right. And taking a look here, you mentioned the Redfin upgrade here, and this is a stock that not heavily traded or heavily followed here. I think Sean Udall had talked about it a while ago. Nice comeback. This is, I believe, the online real estate broker, and getting a lift here up 87 cents. At 21.14, that's was there? Let me see if there's any volume associated with this or not, because that is a big move for a $21 stock. And what does the volume tell me? The volume tells me, I see 5,000 shares traded, then a couple odd lots here. It was even higher than this. 21.74 if you were up at 5 this morning. I think that's a little much for this stock on an upgrade.
I don't know if I'd say that, because this is a stock that isn't, like you said, widely followed. When you get an upgrade, people take note. So you've got a breakout here now over 21. Stock opens up. I don't know if I never like chasing stocks, but this thing pulls back and you can get it in the mid 20s today. I kind of like it. So I don't like chasing something up 4%, but who's upgrading it?
Yeah. It was upgraded by Piper
to overweight.
That's big. Piper's big, very influential. So you got a big call from a major analyst that's obviously probably followed over at Piper, and the stock's breaking out here now. I think there's room to 25 on this thing. Okay. So I like it on a pullback. So maybe that's why we have a market here. But I think you got a breakout here. Can it get and hold those highs? It's obviously got to stay breaking out. I mean, when you're playing breakouts, that's the key, that you want them to stay breaking out, and you have to have a contingency plan always. But I'd say as long as this thing holds above $20, and I don't mind it. So I kind of like it. Not buying at 21.14 necessarily, right? But you get 20.70, 20.80. Maybe you stop out under 20. I kind of like it. I like the setup.
23% short interest in that one too.
I like it even more now. So,
all right. Well,
next, Or we're at 9 o'clock.
Well, we're at 9 o'clock, so the next will be the wrap for the show. So it's good to be back. I missed you all. Thanks to everyone for joining us today. If you missed any part of our show, you can catch our podcast, iTunes, SoundCloud, Stitcher, TuneIn, or Google Podcasts, or just rewatch the show on YouTube. Thanks to our guest, Steve Sears. Thanks to all of you in our chats on YouTube and premarket.benzinga.com. We'll be back with you folks on Tuesday. In the meantime, have a good rest every day, and we'll see you tomorrow.